Okay, so we are going to start. We are going to do two things today. One is interest rate derivatives, and then we move on to options, which is the final topic. These two topics will be able to cover. So first time for on the both the topics there will be question, okay, in your exam because they're happening at the end, so you will remember them. Okay, fine. Interest rate risk management. So so let's begin. Uh, why do companies need interest rate risk management? I'm just keeping this here. Okay. Here we are. भेजी तो नहीं है ठीक है Okay. So why do companies need interest risk rate risk management? Because interest rates keeps going up and down in the economy. They don't remain stable. So that and it can affect the company's profitability, its existence. Okay. So that's why it needs to be managed. Now, volatility in cash flows. Changes in interest rates can lead to increased borrowings, cost, or reduced income from investments, creating a volatility in cash flows. When you're doing business, because if the interest rates go up and down, so it will create a volatility in your cash flows. The cash which the company can generate can go up and down, and even it can increase your borrowing cost. And even if you have made some investments, so you can it can they can be affected because of the interest rate changes. So the investments also get affected, okay? Because I'll tell you later how it gets affected, but let's move on now. Cost of borrowing. Uh, for companies with significant debt, rising interest rates increase the cost of borrowing, impacting the profitability. Okay. Then asset liability mismatch. Now, and this is particularly in the case of finance companies because they have liabilities and they have assets. Now, liabilities in form of the money collected from depositors as fixed deposit, at saving accounts, so bank needs to service them. They pay interest. Okay, and then they give loans. All the money which they collect through all those deposits and other sources, they give it to the industry or to the people for making their houses. They take loans. So they have assets and liabilities. Now they are always a mismatch in case of financial institutions or bank because the loans are given generally for a very long period. Like suppose you take a housing loan, you get a loan for 15 years. A corporate loan is also again 10 to 15 years. Whereas the deposits are only short term, 1 year, 2 year, 3 year. Okay, the interest rates can change, can impact the profitability of the companies because there is an asset liability mismatch. The bank's assets, long term loans, and liabilities, short term deposits, have a mismatch durations. Rising interest rates increase the cost of liabilities. That means the deposit cost will go up, fixed deposit will carry a higher interest, while the asset returns remain fixed. If the most of the loans they are given on a fixed term, then it is going to squeeze profitability and leading to financial stress. So banks have to do something, so they have to give loan on floating loans more rather than fixed, so that they can manage that liquidity, that problem. So if you look at this site, uh, it tells you about how the interest rates are moving in India. Basically, it is the rate at which the RBI lends money to the public. Okay, it's on. So if you just go to this, site, this will tell you about the interest rate scenario in India. This is the interest rate in India. That means the RBI lends money to the other banks for short-term purposes. So if you see the interest rate, say in the last 5 years, so it's like this. So currently the bank repo rate is 6.5%. That means when another bank approaches the RBI or any other bank, the rate of interest they are supposed to charge is 6.5% because RBI has assured that they will lend the money at 6.5%. So other banks will also lend at that rate to another bank on a short-term basis. So this has been steady from last few 1 or a year or so because the RBI has maintained a pause policy and they're not increasing the repo rate. But if you see, the repo rate has been rising. It was around 4.4%. Okay, and there is kind of increased to 4.4% to 6.5% over various kinds of repo rate hikes which the RBI has conducted because of checking the inflation in the country. So they want to reduce the inflation. So they have a monetary policy. So they, whenever they feel the economy is heated up, they will come and increase the repo rate. With increase in repo rate, the fixed deposit rates will also go up. The lending rates will also go up. Okay. So if you even look at your 10-year chart, so you'll find the interest rates are always changing. They were very high at this time, above 7.75. Then, they were brought down, and then it went to as low as 4%, and then it remained 4% for some time. And then because the economy inflation is going up, so RBI came into and they started increasing the interest rates. Now RBI they have a twin, kind of policies. They look both for, because they want to check the inflation. Whenever the inflation is rising, economy is heated up, so they'll use their monetary policy to check that inflation. Another is the growth, objective of the RBI. So RBI also want the economy should grow. So they have two objectives: to check and keep the inflation. So their primary objective is to keep the inflation down. Growth, they also factor in, but it is the government job to see that the growth goes up. So the government primary job is that the growth should be maintained, whereas RBI primary duty is to see that inflation remains under check. Okay. So now coming back to the slide. So asset liability mismatch we have done. Now, volatility in cash flows. So let's understand this through an example, how it affects the companies. Let's talk about a case study here. Jet Airways, we all know, a company which has now been closed. So Jet Airways was one of the India's largest airlines. The aviation industry is a capital intensive, and companies in this sector often really rely heavily on debt to finance aircraft purchases, because these air companies, they have to procure aircrafts, so they need a lot of money. Now all the money cannot be given by the shareholders, so they have to borrow money from institutions, or they take aircraft on lease from companies like Boeing and other companies. Okay. So lease agreements and loans and working capital. So need to manage their working capital also, the requirement for meeting day-to-day expenses. So they need money, a huge amount of money. It's a capital intensive industry. So either they rely on equity or they rely on debt. On debt means they have to take finance from by way of taking loans to meet both their working capital or their fixed capital requirement. Consequently, fluctuations in interest rate can significantly impact their cash flows. So if the interest rates goes up and down, so it can impact their profitability. So as of 2018, Jet Airways had a debt burden exceeding 8,500 crores at that time. A significant portion of this debt carried a floating interest rate, exposing the company to interest rate risk. So they have taken most of the loans which are on the floating. Sometimes the banks insist that they will be lending at floating, and they make the fixed rate very high, so that the companies, they go for floating, so that if the interest rate goes up, they have to pay more. If the interest rates go down, they have to pay less. Now, rising interest rate in 2018. So this is a scenario in India. The interest rates were rising, and there were revenue pressures because there were a lot of other players coming into this thing, and the tariffs were dropping in this period. Volatility in cash flows was witnessed, and increased borrowing cost. So the Reserve Bank of India raised the repo rates in 2018 to control inflation. The increase in benchmark rates led to a higher borrowing cost for the corporates. For Jet Airways, interest rate expenses increased substantially, affecting the net cash flows. Now they were at the same time they were experiencing on their top line also some pressures. Concurrently, Jet Airways faced a competition pressure and slowdown in revenue growth due to increased competition from low-cost carriers. Rising operational cost, particularly fuel expenses, compounded the problem, leaving a little room to absorb higher interest cost. So volatility in cash flows, the result was the cash flows were not stable. Higher interest rates reduced the company's ability to generate sufficient free cash flows. Due to the liquidity challenges, the airline delayed payments to the employees, vendors, and lessors. So which is affected in increasing having operational disruptions. The banks and financial institutions, wary of Jet Airways' deteriorating financial health, demanded a higher interest premiums on loans. So that time, the new loans which were given were at a higher, and even the Jet Airways, their credit rating came down, and further loans became very expensive for them, which further strained the cash flow position of the company. So if you look at the financial health of Jet Airways here, so in 2016-17, their net interest expense was 600 crores, whereas they are having cash flow from operations of 1,200 crores. So they were stable cash flows in during this period. But suddenly from 2017-18, we witnessed there was an increase in the interest cost, went up from 600 crores to 850 crores, and the cash flows came down because of the increased pressure, because of the rising interest cost, so decline in cash flows. In 2018-19, it was a kind of a very bad situation. Interest rate went up, interest cost went up to 1,200 crores, and the cash flows became negative. So severe liquidity crisis was witnessed at that time. So this was the financial impact on the Jet Airways, bottom line and the cash flows, which ultimately led to the closure of the company because of the interest rate changes. So the company needs to manage interest rates. Okay. So consequently, operational uh, disruptions, loss of stakeholders' confidence, bankruptcy. Ultimately, the company became bankrupt and they couldn't manage their interest rate cost. Aircraft lessors repossessed the planes due to delayed lease payments, so they are not able to make payments to their to the lessors, and the companies, they repossessed their planes. The company was unable to service debt, leading to a default. Credit rating was downgraded, further increasing the cost of borrowing. In April 2019, Jet Airways ceased operations due to an unsustainable financial position. So, because of this impact, it can cause and can even affect closure of companies. Okay, the companies can be badly affected. So that's why the lesson is that we should manage our interest rate risk, and we have to keep the interest cost as low as possible and try to use some kind of derivatives to manage it. So we'll understand that. So there is a sensitivity to interest rates. High debt levels with floating interest rate expose Jet Airways to significant interest rate risk, causing cash flow volatility. Leverage risk, because they were high in debt, companies with high leverage need robust cash flows management and interest rate hedging strategies to mitigate the risk. So this is what we are going to study: how the company manage the interest rate risk through various derivatives. So sector-specific dynamics. Capital-intensive industries like aviation are particularly vulnerable to interest rate changes, necessitating the prudent financial planning. So lessons for other companies: uh, diversify borrowing sources, use a mix of fixed and floating interest rate loans to reduce the exposure to interest rate volatility. That means if a company is going for loans, they should have both fixed as well as floating. Okay, and there are other derivatives which can help them to protect such kind of changes in interest rates. Hedge interest rate risk. Leverage the financial instruments like interest rate swaps or options. So this is what we are going to study mainly today, and there is going to be a question on interest rate swaps and options in your exam. Focus on cash flow management. Maintain a strong liquidity buffer to withstand economic shocks. So, if you just go to a site here and understand, some of the companies in India, how they are placed in terms of debt. So, if you go to, a screener and see, for example, the company which, so I'll just log in so that you can see everything. So, particularly first, we'll go to the biggest company in India in terms of market cap, which is Reliance again. Then we'll revisit other companies. So, if you look at Reliance Industries, okay. So, look at the balance sheet here, okay. Look at the equity capital, which is 6,766 crores, and their reserves are 8,12,000 crores, which belongs to the shareholders. So, the shareholders, these are reserves created out of what? Huh? Profit. The profit which has been retained back by the company and not declared as dividend, so that has been plowed back into the business, and that is again invested into various assets of the company. So this remains as a reserve in their balance sheet. So this is belongs to the shareholders because this money has not been given to the shareholders; it has remained in the company. So then we have borrowings. So borrowings are how much? 3,57,000 crores. So this is the company which is having one of the biggest in terms of a non-financial company, which has the highest loan book in the country, which is 3,57,000 crores. But if you look at year before, it was 4,58,000. So, every company would like to decrease their borrowing because nobody wants to borrow heavily because the debt needs to be serviced. Okay. And in bad times, it becomes very difficult to service. So, because the business can go through various cyclical, kind of up downs. At the moment, India is passing through a cyclical downturn. Okay. That's why we're witnessing stock markets also softening. So, so it was 4,58,000 a year back. Now it has been brought to 3,57,000. So they have brought more equity shareholders. Okay. But they brought them in, I think, 2022. or 2021, when the share capital was 6445, and then it went up to 6766. Okay, so they came up with a issue, and then the money which was collected from a rights issue, one of the major investor was Aramco of Dubai. They gave a lot of money to the company for, and that money was to reducing the debt of the company. That has happened in the last year when the share came down from 1:1 bonus was there. So the bonus will not have any impact as such. Bonus is going to just increase the number of shares. Okay. So if you look at the shares here, the number of shares at 61353. It was just the half. It was 600 something crores of shares. Now it has become 1,353 crore shares. So anybody who was having one share, now he has two shares. It is not going to impact only the, it is only the reserves are going to come down. Okay. And that because of the bonus issue. Okay. So now coming to this, if you look at the borrowing position, of course, if you see, it was 1,38,000 crores in 2014, and now it is 3,57,000. So company needs more and more money. Company have to borrow. Company needs to borrow. Okay. So let's understand now, that how does it stand on borrowing? So if you look at borrowing, debt to equity ratio is 0.44, which means 0.44 paisa of debt for 1 rupee of equity, which is quite healthy. Okay. So it has to be below 1 for a company to be in a very comfortable situation, particularly the companies which are very capital intensive. Now, there are companies in India we don't even borrow anything. Okay. Then the interest coverage ratio, which is very important, that how much they are earning, and what is the interest outgo. So they are earning 5 times the interest what they have to pay. So there is an interest coverage ratio of 5.38. That means their operating profit is 5 times more than what they have to pay as interest. So if you look at, say, for example, another company, for example, Tata Motors, which is again a company which is capital intensive. Let's understand, how they have done it. So look at their debt to equity ratio, 1.05. So they are in more debt compared to, of course, when you go and check their interest coverage ratio is far below than Reliance. Okay. So their financial health is not as good as Reliance, though Reliance is a much bigger company. Look at the amount of loans. Of course, in terms of loans, they have almost 1/3 of the loans, 1,06,000. Okay. Which was almost half about 10 years back. Now it is standing at 1 lakh. Now there are companies like Adani, which is, highly relying on, Adani Enterprises. The debt equity ratio is 1.92. Okay. And their interest coverage ratio is just 3.01. So these companies are not so financially managed well because of they have a low interest coverage ratio. Any shock can affect their profit. That's why the Hindenburg report, which exposed the company, that the company was sitting on a lot of leverage, and this can impact their profitability in future if something happens. Hmm? Zomato might have taken some loan, but let's see. It is 0.05. Zomato is not, because it's not a very capital intensive industry as such. Okay. So it doesn't require so much of capital for making, factories and all. So if you look at even, their interest coverage ratio is 7.45, which is quite good. Okay. And if you look at, the borrowing, which is only 1,100, very small amount because it's just a new company, not a very old one. Okay. So interest rates can affect basically the company's fortunes going ahead. So that's where they need to manage. So now coming back to the same question,